Hello students, how are you all? Okay, so today is our Ind AS 40, video number 6. It's 6th, and in the previous video, we were on exchange of assets. In previous class, exchange of assets was introduced. If you remember, so we were discussing concept number 5 in class, under the name of initial recognition. Purchase by cash is done, self-construction is done, and deferred credit is completed. And the fourth concept we started is this, the exchange of assets. And in the exchange of assets, I only taught you this, that whenever we buy any investment property, so we don't make its full payment in cash. Instead, we give some of other assets and just some payment in cash. And so the cash that we get in the exchange is for only to balance the values. Got it? And if the values are equal, then there is no need for cash. So we will buy the new asset and give the old asset. We called this an exchange, and I emphasized on one thing in class, that the accounting for exchanges depend on just a word, and that is on commercial substance. The accounting for exchange is only depend on a single word, and that is the commercial substance. So if the commercial substance will exist, then the accounting will be different, and if this doesn't exist, then the accounting would be entirely different. Getting it? Both the cases are different. And after that, I taught you the meaning of commercial substance, right? The meaning of commercial substance is that the asset you are bringing in, which is your taken up asset, and the benefit of it is different from the given up asset. Okay, so suppose you are buying any new asset, and in exchange you are giving your any old asset. So the benefits of both of them, the benefits in the form of cash flows, because when you use any of asset, then you will receive its benefits in the form of cash inflows. So the cash inflow from the asset being received is different from the cash inflow from the asset that is given up. Therefore, it means that your commercial substances exist, okay? This is the meaning. And if commercial substance exists, means that the asset which you are buying is better from the asset that you gave up. So we always exchange assets to increase the cash flow and not to decrease the cash flow. So no one wants to do that type of exchange in which one's cash flow decrease instead of increase in cash flow. So the point is that if the commercial substance exists, then how will we do its accounting? So here we were in last class, so we'll continue that. And today we will try to finish this concept number 5. All right. The initial recognition, and then we'll start the concept number 6, subsequent recognition. So let's start. Okay, so write that in the bracket. So from here, we'll use fair value model. Fair value model. We will use the fair value model. It's very important. So please pay attention here. I'll teach you that is written in the study mat. Let's assume. Don't write down. So let's assume the taken up IP. And the fair value of this, fair value means the market value. Well, it's different from the market value. Fair value is the transaction price for those people who are willing to make the transaction. So market value is the demand price which we demand. So, for example, you went to a bookstore and asked the seller that you want the book of ABC author, and you asked its price. And it's 1200 rupees. So you bargained with the seller, and then he gave you a discount of 200 and you gave him 1000. So market value is 1200 and the fair value is 1000. Market value is 1200 because of its demand. But why is the fair value 1000? Because transaction is of 1000. So fair value and market value are generally considered the same, but market value is always higher than the fair value if market value is equal to the fair value, then the bargaining power is 0 and there is no discount. Generally, fair value is lower than market value. So fair value is the transaction price. We think that deal will be done on this. Guys, pay attention. So the investment property which you have purchased, and we found its fair value. So 20 lakh rupees. We identified. It's evident. Here evidence means that we have the evidence for it. We consulted with valuers, conducted a survey in markets and found that the property value is around 20 lakh rupees. So the evidence shows that we have the proof that the asset you purchased in real was actually of 20 lakhs. Understood, students? Given up assets, the fair value of these is unknown, not evident. We don't know. WDV of given up assets. So now you can't deny this thing that the asset you are giving upon and the asset you are exchanging, which is your old asset, so it must have some value in the books, right, students? So the value that is in your books, we call it as the carrying amount. And the carrying amount of this is 15 lakhs, and I found this information in the books. So this becomes your case 1. This is your case number 1. So you identify the case 1. What information is in it? So we will call this case study. As everyone pay attention to what I am teaching you. So all ears here, guys. Fair value of taken up assets is evident, but fair value of given up assets is not evident. We know the fair value of the assets which we'll receive. We don't know the fair value of the given up assets. That's first case. This is stated by study mats. Let's study one more case. Taken up assets. We don't know the fair value. It's not evident. Fair value of given up assets that were given up. We found out the fair value of this is 28 lakhs. And its WDV is WDV of this. WDV that is of 25 lakh. So this is the second case. This became the second case. Okay, students. What will be the heading? Its heading will be the fair value of taken up assets. Is not evident. But fair value of the given up assets is clearly evident. It's reversed. The fair value of receivable assets is unknown. But you know the fair value of given up assets. That's second case. Now the third case. Taken up. Fair value 25 lakh. Given up fair value 28 lakh. WDV of given up 25 lakh. Let's take this as 20 lakh. This became the third case. The third case. You know the fair value of asset that will be received. And also the fair value of the given up asset. There are maximum of 3 cases. What's first case? Do you know the fair value of receivable asset? Yes. Do we know the fair value of given up assets? No. You know the value of receivable assets? No. Value of given up assets? Yes. Here the fair value of both is available. This is evident. It's also evident. So these 3 cases are there in your study mat. Okay. And the accounting rules are different for all 3. And do you know about the situation? The situation is that in the transaction commercial substance exists. The cash benefits of receivable assets is different from the cash benefits of the given up assets. The enterprise will benefit from the exchange. That's why these are commercial substance and we applied the fair value model. Now the problem is, the issue is that the study mat has discussed about the three concepts, right guys? But suppose it's an example, okay, so you went to a car showroom and you bought a new car and you gave away your old car, purchased a new car and sold the old car. New car is of 20 lakh. Old car was of 15 lakh and you paid the difference of 5 lakh in cash. This is practically understandable. So I understand that practically. But I don't understand practically this. That fair value of the receivable asset is known to you. And also you don't know the fair value of the given up asset. So can you guys? Without knowledge. That without the proper knowledge, would you exchange? Would you like to exchange? So don't you think that the assets which you are giving away without the knowledge whose fair value you don't even know? So don't you guys think that there might be a possibility that you are exchanging your expensive asset for a cheaper one? It may be possible. So in practical life, no one would exchange something without knowing the fair value of their asset. We know the price of receivable asset, but we don't know the price of the given up asset. So it's not a practical thing that we can follow in real when two people exchange. So the fair value means a transaction between a knowledgeable buyer and a knowledgeable seller who is practical in nature. They mutually decides the price. And in examples, we are just talking about study mats continuously and its example repeatedly. So we are not convinced by these three examples at all because we think that in a practical scenario, this is not justifiable explanation and is not practically applicable. It's like if someone asks me to exchange my plot in Delhi for a plot in Punjab. Are you understanding? Why would I do that? So rates are higher in Delhi as compared to Punjab. Rates of any city in Punjab doesn't match with Delhi. And value of Delhi doesn't match with Mumbai. Mumbai value is higher than Delhi. So the person with lower value will be in favor, then the person with the higher value will be at loss. So it's not right. So exchange always happens at power value. And when someone explains the concept of exchange to you, so let them know that you have studied according to the study mat, but he also taught us that it's not practically possible in some scenarios. And when you buy new car from the showroom in exchange of your old car, so at that time, then why don't you apply the study mat rule? The company tells you that new car is of 25 lakhs and your old car is of 5 lakhs. So we will take an additional 20 lakh from you. So these rules don't apply there. So did you guys understood my point which I explained? So this is the first example. It is not practically possible, but it will come in your exam. So you have to study according to study mat. So in study mat, how will you do the accounting? So if you do not know the fair value of given up assets, so just assume that for now about the fair values. So use this 20 lakh. What entry will be passed? New asset debit. The new asset is of 20 lakh because you know the fair value. WDV of the old asset is 15 lakh, so remove it. Remove the WDV of the old asset and 2 P&L. Book the gain of 5 lakh. Entry is done. From here, one thing is clearly understandable. That if you know the fair value of the taken up assets, and it's fine if you don't know the fair value of given up asset, so pass the entry on taken up value. WDV of old assets. And so the fair value of taken up, so the difference in this will be the profit and loss of your exchange. In this carrying amount was less. We are taking interpretation. If you receive an asset of 20 lakh and give away an asset of 15 lakh and you have gained 5 lakh. So practically, firstly, when both fair values are evident, then only the exchange is possible. Second point, the difference between the two fair values is settled in cash. Only then both will be satisfied. It's practical. But the concept given in the study mat, We have accepted that we have to follow whatever is there in study mat. We cannot change it. We have to study accordingly. And I have audited thousands of companies. Also conducted seminars. If you talk to any CA, they will also explain as what I have explained to you all. In the exam, you should work according to the study mat, only study mat. That is everything. I am telling you this because the study mat is important. So guys, just study from the study mat only to pass the exam. So students, write according to study material in exams. Whatever is there, just study that if it's practical or not. Because that's what important for exam. Because as we have studied that there are things which were not practical from our point of view. They are dependent on study mat and not practical knowledge. So practical learning is ignored nowadays and rote learning is taking importance in this generation. Understanding? So now let's look at the second case. So we can leave this as we don't know the taken up value. Let's take this and pass the entry, new asset debit, 28 lakh, to old asset, 25 lakh, and book a gain of 3 lakh, and this gain will go to the P&L. So if you know the fair value of taken up, then you can record it. And the value of given up, then record it. If you have given an asset of 28 lakh. So if you have given up an asset of 28 lakh and your new asset will also be of 28 lakh. Clear guys? So if you don't know the fair value of the taken up, so then the fair value of given up will become the cost of the new asset. Understood? The difference of the old WDV will go to your P&L. So this means take the fair value of the receivable asset, use fair value of given up asset if it's known to you, which is clearly evident. You can consider it as the cost of the new asset. And also they recognize the carrying amount of the old asset. Calculate profit loss difference on exchange. Thus my point is an exchange is not possible here. So until and unless if both of them doesn't know their own value, then why would they prefer the exchange? Example is incomplete. These are incomplete examples. Practically impossible. Who will even try that? Let's just imagine that this happens. So just accept it as it's in the study mat. If you know the fair value of both, if you know the fair value of both, if both the fair values are clearly evident, then what will happen? So, purchased for 25 lakh and you have given an asset of 28 lakh. The difference should be settled in cash. It should be right. Why would someone give an asset of 28 lakh for an asset of 25 lakh? So 3 lakh should be settled in cash. But study mat says no. So if both of these are evident, thus you should always prefer for given up. Clear guys? You shouldn't take the fair value of taken up. You only need to consider the given up. So the assets that you have given up. The assets that you have given up. So that is your fair value, and hence I will pass the entry. New asset debit 28. To old asset 20. To gain it. And you should ignore the taken up. Hence students, you need to apply that because it's in our study mat. And I have mentioned this in my previous classes. So I hope you all are understanding. This was also in your old study material. The new study material that came with the new scheme also has the same thing. New study material provided by institute under new scheme mentions the same thing. So if you knew the fair value of receivable asset and also the given up asset, then use it. And if both of them are available, then prefer the given up. So remember this, always prefer given up. It's important, so please understand this. Hence you don't have to take taken up, just focus on the given up, just remember that. But so far in these examples we have not talked about the cash. So let's involve cash now. If it's written in this example, cash paid 1 lakh rupees cash paid 1 lakh rupees. So I'll say that I gave the asset of 28 lakh and paid 1 lakh rupees in cash. So here I gave out 29 lakh. So I will assume my asset cost to be as 29 lakh. If we get the cash payment, then both will be added. So if you have given some cash along with an asset that comes in, the given up only. So you need to take the value of the given up asset. Okay. Hence 28 lakh is fair value and you paid 1 lakh in cash, making it 29 lakh. So here you need to prefer what's going out from you. Getting it? So just remember the word given up. Okay. So we'll be doing 3 examples. And firstly, we will be doing 3 examples without cash. After that, we'll include cash as well in the examples. There are 5 or 6 examples. And in your study mat, an example is given and we will do that example also. Don't worry. Okay, so let's start. And you want the logic. So the logic is very unclear here. There is nothing convincing. But you need to pass the exam so because of knowledge. But I just want to know that who has included this, which is totally unreal from practical life. These concepts in study mat, one cannot apply those in real practical life. So I would have given you the classes based on the records from 2018 and from 2019. When Ind AS came first time, then we recorded a batch in 2018 and also in 2019. I have recorded all concepts after correction. After that recording, students claimed it doesn't match the study mat. That the answer does not match with the study mat. They just believe the study mat. So at that time, I have decided that I will from now onwards teach students from study mat only. From starting 2020, 2021 to 2025. So all the recording you got or will get in future. Those all recording I have prepared according to study mat. And I will continue with that. So priority is knowledge and do the correct thing. Give its explanation. But that's not right. As it's not in study mat. So just study according to the study mat only, that will help you. Now write examples of case 1. If fair value of taken up assets is evident. You raise your hand. If you have any question, so in previous video I told you all that the concept of exchange will remain the same for all Ind AS. So let me tell you guys a thing that this is same in all the Ind AS. You need to keep this in mind. While appearing in exam, and after that when you become a CA, do that. What is logically right? What do you think is practical? Fair value of taken up assets is evident. But fair value of so the first case. In the given case, we will prefer we will record or we will recognize cost for new IP equal to Fair value of taken up assets. The difference between fair value of. So let's break these down into steps. So you'll get to know that about first step. The second step, difference between. Fair value of. Taken up assets and WDV of given up assets. Will be considered. Gain and loss on exchange of assets. And this gain and loss, this will go to the profit and loss. Let's move now. Write the example. Fair value of taken up assets. Let's take 20 lakh rupees. Fair value of given up assets. Not evident. We don't know. If it's unknown, the topic is over. WDV of given up assets. ₹12 lakh. 12 lakh rupees. If you need to pass the general entry, then just simply 20 lakh rupees worth assets we will record. We will derecognize 12 lakhs. Your difference will be 8 lakhs. Cash? No cash. Because it was not in question. Okay, now to pass the general in this. It will be a very simple entry. We will write in this. Investment property account debited by 20 lakh rupees. To assets, WDP of the given up assets which we are derecognizing, hence the assets that you have transferred. It should be derecognized. 12 lakh rupees. The difference of this becomes the gain. If an asset of 12 lakh is of 20 lakh now, there will be a profit. So profit will be there due to this conversion. We have never seen any profit on purchase of an asset. We have been learning since 11th grade that there is profit or loss on sales and the purchase is at cost. So we can know that it's a Ind AS. And according to ICI study mat, there can be a gain in a purchase. So you have to understand this point. Being exchange of assets made. Yes, you can definitely write profit and loss instead of gain. I have no problem with that. To P&L. I have no problem. You can write that. Another example. With the help of given information. In previous example, pass journal entry for exchange, assuming there is a cash payment of 2 lakhs. Is also involved. Example is same. And with that we also made a cash payment of 2 lakhs. This means that you did not give only 12 lakhs rupees in WDV. You have 12 lakhs of WDV along with 2 lakhs of cash were also given with it. So we gave asset worth 12 lakhs and gave 2 lakhs in cash. So 14 lakhs rupees are gone. But tell me this first. How will we recognize it? Do you know the given up assets fair value? The answer is no. So what do we prefer? We prefer the taken up. Taken up is worth 20 lakhs. It will remain 20 lakhs. We got 20 lakhs asset. In exchange, a carrying amount of 12 lakhs was given up in cash payment of 2 lakhs. So 14 lakhs rupees are gone from your pocket. So you can see your gain here is 8 lakhs rupees. Your gain will be left only 6 lakhs. But it will not impact the recognition. So this means that whether there is the involvement of cash or not, your first recognition will remain on the fair value of taken up. The fair value of the taken up amount doesn't change. It remains unchanged. Did you understand that? In first case, from giving cash, it will impact your gain or loss. That's all. In the case 1, because we are seeing taken up, we are not looking at given up. Did you understand what I said? We are looking at taken up only and not looking at given up. We don't seem to care about the things that we gave up. The point is we only care about what we bought. This is case 1. So if you want to pass the entry here, let me pass the entry here. You have to keep this in mind. I have attended many seminars. I've asked things to many educated people from institutes. I haven't received an answer yet. I didn't get the answer. Now institute says this is our home. Since that, so this is our own concern. The student's teacher The members and the CAs. We are only 4 people. Well, there are only 3 people. The teachers are also CA and members of the institute. So students, members and ICI are the 3 pillars of your institute. They'll fight with each other. It will be shameful if the house matter goes outside and break people's trust, so we are silent. We can't slander our own home, we are silent. Because it's better that way. That's why I don't say anything inappropriate here. I also want to make a statement publicly and cause stir. It would be fun, but it would be my own downfall. Write this here. Investment property debit. So how many rupees are actually there in it? These new kids who are teaching on YouTube, they see the study material and proceed according to it. In practice, they have done very little work. It will take time to gain experience. Investment property 20 lakh rupees. To assets given up. How much rupees? How much is there? 12 lakhs. To cash. Cash. You paid 2 lakhs in cash. Don't look at given up. To gain on exchange. So gain on exchange is 12 plus 2, 14, so 6 lakhs. Being Let's go to second example. And now the second case has come up. If fair value of taken up assets is not clearly evident, but fair value of given up assets is clearly evident. It's second case. The upcoming asset is unknown. We know of the given up assets. This is the second case. The first step we will recognize the new IP at fair value of given up assets. Monetary plus non-monetary. If you have given any cash, so that will also become plus. I gave an asset worth 12 lakhs and 2 lakhs in cash, so I gave a total of 14 lakhs. This is the total fair value of my given up. It doesn't matter what we gave in the previous case, because we look at the fair value of taken up, but in the second case we need to consider what we have given up. So whatever items you give, they will be added to your cost. Okay. Yes? Second step. Difference between difference between fair value of given up assets and carrying amount of given up assets. Shall be considered as the gain or loss on exchange of assets. Okay. Please write an example here so that it's easier to understand. Fair value of taken up assets. It's not evident. I don't know how many. Second, fair value of given up assets. Let's assume this is worth 20 lakhs. Do you know what carrying amount means? It's not like. I think you don't know anything at all. Carrying amount means WDV. We can also call it book value. The values recorded in your books are called the carrying amount. Your books are carrying those. Okay, so if you want to add a solution to this example, please tell me what the fair value is. Given up fair value is 20 lakhs. So we will assume that your new asset is worth 20 lakhs. Will pass entry. Investment property debit. Investment property debit to assets given up. Tell me how much are these? They're 25 lakhs. How much is the loss? Gave the assets at 25 lakhs and received at 20 lakhs loss on exchange. So in a way, it is assumed that asset worth 25 lakhs was sold at 20 lakhs. Because you have 20 lakhs consideration. So remaining 5 lakhs is loss on exchange. Balancing figure being another example. If cash payment of 5 lakhs is added to the given information, in above example, Then what will be its impact on recognition of IP? The example that I just wrote down, if an additional cash payment of 5 lakhs is added to it, so what impact will it have on your recognition? Now it will. Why? Because we are looking at given up. Cash payment didn't impact the previous case as we were focusing on taken up there. But now we have to take given up. So what did you do? Fair value of 20 lakhs. You gave an asset worth 20 lakhs. And you are also paying 5 lakhs in cash. So you gave 25 lakhs including monetary and non-monetary. So the new asset you have is worth 25 lakhs. You gave an asset worth 20 lakhs and 5 lakhs in cash. So the total value of the asset given up is 25 lakhs. So your asset will now record as 25 lakhs and not as 20 lakhs. Okay, it will impact. And this impact did not occur in the previous case because they consider taken up value there. We don't even see what all is given. They just take the taken up. Here you have to take the given up. And so you have to count everything that is given. It's a different matter. If we pass a journal entry in this, so we will write investment property account debit 25 lakhs. We will also write notes to bank 5 lakhs. Two assets given up. What is the given up? The carrying amount is 25 lakhs. Loss on exchange. It is 5 lakhs. This means the loss was 5 lakhs before and it is still 5 lakhs. The cash payment you made will be added to the cost. The loss was 5 lakhs earlier. The loss is still 5 lakhs. But your asset will record from 20 lakhs to 25. This means when we look at the given up value, when we take the value of the given up, the cash that is paid becomes part of the cost. Being exchange of assets made. I'm only just trying to explain this much, that the cash payment is not relevant in case 1. It does not impact the cost. But when the case 2 comes in and we start looking at given up, so whatever cash we pay, that gets added to the cost. You have to keep this in mind. I want you to write this note. When we consider fair value of given up assets, then payment in cash. In addition to fair value of assets given up It means that the fair value of the given up assets shall also include cash payment. While making recognition of new IP, take cash with us. Whatever is given will be calculated. Now third case. Case 1 and case 2 is done. Third case. You all create third case's heading. If both the fair values are clearly evident, what does both mean? Taken up and given up. If you know both of the fair values. Now tell me, I had told you that the institute has clearly written in the study material that always prefer given up. If both the fair values are known and both of them are clearly evident. So you should know that your case number 2 will be repeated. Why? Fair value of given up should be preferred. Don't see taken up. What happens practically? Fair value of taken up. The difference between the fair values given up and taken up is settled in cash. Otherwise, one or the other will suffer loss. This is what happens practically. So do whatever they are asking. Let's say that I have a plot of land in Chandigarh and its price is 4 crores. Another party has a plot in Delhi and its worth is 20 crore rupees. Now property worth 4 crores will be exchanged for 20 crores. And 16 crores cash will not come in between. So the person with cheaper plot will have advantage and person with expensive plot will be at disadvantage. Why would Delhi plot owner take Chandigarh? Isn't practical. If I'm giving away my 20 crores property in exchange for 4 crores property, I'll tell the other person to pay 16 crores cash. Then I'll get my 20 crores. If that doesn't happen, I will be at loss. I won't exchange it. This is the same as saying that you have an iPhone and you are giving it away. You are exchanging the iPhone for a OnePlus phone and there is no cash involved in the exchange. So the iPhone owner will be at a loss and the OnePlus phone owner will be dancing. So you are saying this doesn't happen practically. You have never seen it happen. Yes, I have an assumption that both are smart. And if any of them is not smart enough, they could be at a loss. But in the real world, when we go to make a transaction, everyone understands that man is a fool who thinks others are fools. Understand that those who think they are over smart and consider the other person to be a fool are fool themselves. If other person is not speaking, doesn't mean that he is stupid, he just isn't reacting. That's the difference. I am telling you this indirectly in roundabout way. You are sitting in your circle of friends or your family circle. If you are in a professional setting and the person in front of you is not reacting, then don't assume they're stupid. He is actually smarter than you. He is listening but ignoring. Okay, so you agree to this and what should I do? Right. The first step fair value of. Given up assets. Shall be considered. For recognition of new IP. Okay, so fair value of given up, just assume it. Ignore. Fair value of taken up. This is the truth. Of today. This is the truth of today. Second step. Difference between. Fair value of given up assets and WDV of given up assets shall be considered as gain or loss. And it will be transferred to P&L account. Profit and loss will come and we will take and put it in the P&L. That's it. Right example. Take the God's name. In today's world, the God's name is the greatest support. Let's move on. When people were sad in the world, they used to point upward towards the God repeatedly and say to him that there is so much pain in this human world. God came in human form. He showed people how to endure pain and set an example. If King's son can live barefoot in the forest for 14 years enduring pain, and if the God can do that, so they are setting example for the world that you will have to struggle. They have done it and you will also have to do it. This is the lesson. We look at the Ramayana from different perspective. What is the Ramayana? It is a story of sacrifice. A son went to forest for his father, and a guy gave up the throne for his brother. The lesson of sacrifice. They were seeking happiness. Understand? Okay. Example. I will tell you about it some other time, because right now there are many more Ind AS that you need to understand, and some other things too. Along studies, I know these things seem boring to you, but there is a perspective that you should look at. I will show it to you. In the next few chapters, I will tell you things that might be helpful. For example, fair value of taken up assets. Fair value of taken up assets. 20 lakhs. That's all right. Fair value of given up assets. I have both of these. It is 25 lakhs. Cash payment is of 5 lakhs. Carrying amount of given up assets is 35 lakhs. Solution. So what should we do? First of all, we will cancel this. This is irrelevant. So this is irrelevant to us. We will mark it as to be ignored. Ignore. This is that clear. Now, what do you need to do? 25 and 5. You gave assets worth 25 lakh rupees. You gave 5 lakh rupees in cash. The total consideration is 30 lakhs. Because in the third case, you need to look at the given up asset and its total value is 30 lakhs. Total value of given up asset is 30 lakhs. We will pass entry when we are making journal entry. So what will we write in the journal entry? Investment property debit. Investment property debit. 30 lakhs. Because you have to take cash with you. This became given up to assets. Carrying amount of the given up assets is 35 lakhs. So loss on exchange is 5 lakhs. We need to write to cash in this. We prevented mistake in the entry. We received 5 lakhs in cash. $25 plus 5 is 30. They gave up asset worth 55 lakhs and gave 5 lakhs in cash. If asset worth 35 lakhs is exchanged for 25 lakhs, gain should be of 10 and not 5 lakhs. 5 lakhs in cash was missing. I was concerned due to this. But I found the difference in the entry. Being exchange of assets made. And if we talk about the summary, accounting, treatment is same. In case 2 and case 3, in case 2 and case 3, the accounting treatment is exactly the same. Accounting treatment is same. But why? Because in both of these we prefer given up. So this means if value of given up is not evident, then leave it. If the value of given up is evident, then we should prefer it. Is that okay? Let's do a question. This is from study material. This is a question from your study material. It's a very good question. Look. Question number 8 from study material. And write it in your books that it is on exchange. It will be useful to you while revising. Okay, students? Now, Sun Limited acquired a building in exchange of a warehouse, okay? A building has been acquired and they gave away their warehouse. Whose fair value? It is telling the value of the warehouse. So the value given here is 5 lakhs. Now tell me, are we gaining warehouse or losing it? We are losing the warehouse. This means fair value of given up is 5 lakhs. And wherever fair value of given up is available, we prefer that it is confirmed that these 5 lakhs will be counted. And the payment of cash is 2 lakhs in total. Okay, students? 2 lakhs in cash. It became 7 lakhs. They gave warehouse worth 5 lakh rupees. You gave a total of 2 lakhs in cash. So you gave a total of 7 lakhs. Warehouse is worth 5 lakhs and 2 lakhs cash. Total value is 7 lakhs. So the new property that you have will be recorded at 7 lakhs because value of given up is 7 lakhs. So students, the fair value of the building received by the company is 8 lakh rupees. They are also telling value of taken up. That means this becomes case 3 for you. This is case 3. Write it down in book. Write about both values. So the case where both values are evident is clear now. Both values are evident. What should we do in case 3? In case 3, cut this line over here. Why? You do not see the fair value of taken. You only need to see value of given up, which is 7 lakhs. So the entry will be passed at 7 lakhs. Okay. If I give you the solution to question number 8, in the given case, both fair values are clearly evident. So we will consider the fair value of given up assets and we will ignore fair value of taken up assets we will ignore the fair value of taken up assets. You need to pass journal entry. So what journal entry will I pass? Investment property debit. Investment property account debit is 7 lakhs. 5 plus 2 to the warehouse. 5 lakhs. to cash. 2 lakhs. I will put star on it. You are final year students, so you must have understood why have I done this. Being exchange of assets. Being exchange of assets made. You must have understood that. Why did I put this star? Students, I don't know the WDV of the warehouse in this question. What is the carrying amount in my books? So students, how will I calculate loss and gain on exchange? So I will make an assumption that WDV of warehouse and fair value are the same in value. That is why I was unable to calculate loss and profit on exchange. So you need to make an assumption. In given question, we cannot calculate gain or loss on the exchange of assets, because the carrying amount of the warehouse is not given. Carrying amount of warehouse is not given. So we have assumed that WDV and fair value of warehouse is same. That's why profit loss isn't calculated. But we preferred given up. I had to make one entry. The study material that you have also has such a question. I had to spend so much time answering this small question, and the whole concept had to be explained. Otherwise, you would not understand this entry. Okay, students, now let me tell you one more point about this. If in this same question, please listen carefully. If I cut this fair value from the same question and put WDV in place of this, so will this affect your answer, yes or no? Please think. The question is easy. Even in this I am looking for case. Think about it and tell me. If I remove the word fair value from this question and write WDV, so students, will your answer change? Please think. The answer should be changed. The answer should change because now these case 2 and case 3 are not present. Our case 1 has changed. How did case 1 change? Tell me, think about it, students. I have removed fair value of given up and I replaced fair value with WDV. So what happened is that the concept of fair value for the given up assets is gone. When concept of fair value of given up asset is gone, it becomes taken up asset. Now this is case 1, okay? And in case 1, what do? We take value of taken up. So this is 8 lakhs. These will be relevant and this will become case 1. So students, your entry will be IP debit 8 lakhs. So warehouse is 5 lakhs because it is DBV, 2 lakhs in cash. And students, there will be an exchange gain of 1 lakh in this. As soon as you remove fair value of given up asset, it becomes case 1 and then it starts taken up. The answer will be different. It is also solved alternatively in the study material. It is already there and I am telling you because if a child opens study material and sees answer to question, then ask me that it has not been done in the class. The child does not even read question. We have done all cases. By assuming your answer will definitely change. Right? If I want to write in same question. Alternative case. If we assume that fair value from the warehouse is not given. If we assume this, that we don't know fair value of warehouse, then what will we do? Then case 1 will be applied. We will make the entry in this. Investment property debit. At 8 lakhs. So to the warehouse, WDV, 5 lakhs, to cash, 200,000 rupees to make a profit. On exchange, 1 lakh rupees. Balancing figure. Being exchange of assets made, we have applied case 1 rules. Answer will change. If you tamper with values, then cases will change. If cases change, then answer will change. And you know, I have explained case 3. So all the cases 1 to 3, in what situation is this done? Yes, this work is not finished, it is still left. So here the commercial substance are still there, that is why we have done this. That situation is pending. If there is no commercial substance, what will we do? Let's go through this together. Look here. We have already learned this. Look at this. If a commercial substance exists, the fair value model is used. Fair value model. Now we should go to situation 2. This is situation number 2. Situation 2. If commercial substance does not exist. So how will we recognize the investment property? How will we do entry of purchase? So we call it carrying amount. Model. The first thing is, please listen to me carefully. Be attentive. First thing is, we will only assume situation 2 when the practical question will clearly state that there is no commercial value. If this same situation is written, only then we will assume. Otherwise, our answer will be only based on situation 1. Clear? Like I showed you example of study material. So there is nothing mentioned about commercial substance. So we will assume if there is commercial substance present, either of cases, that is 1 to 3, will be applied. But if the question clearly states that a commercial substance does not exist, then situation 2 will prevail. This condition is must. If the question is silent, we will assume this, that it is situation 3, and we will choose from case 1 to 3. Students, that means the situation 2 is very exceptional and rare. Okay. This will only be applied when the question asks us to apply this. Did everyone understood the point? Yes or no? Otherwise, do not apply this. How to apply? Let's say the fair value of taken up is 25 lakhs. Fair value of given up is 20 lakhs. And WDV of the asset that was given up is worth 5 lakhs. And it's written, there is no commercial substance in above exchange. This is written that it is not commercial substance. Now it's written here, you need to understand this, okay? We will not take this. We will not take this. Just do this. Here you have to replace 5 lakh rupees and then make one entry. New assets. Debit 5 lakhs. Two given assets is 5 lakhs. There is no cash involvement at all. There will be no gain, no loss, and no fair value. Is that clear to everyone? You don't have to do anything, just focus on one point. What is WDV of given up asset? Take this carrying amount and replace the new asset. Think of it as if the name of the asset is changing. There is no change in the values. So there will be no cash, no gain, no loss, nothing at all, okay? The value will remain same in books, only name of asset will change. The new asset has arrived and the old one is gone. When the cash benefits of the new asset and the old asset are the same, so how can you then tamper with the books? When the cash benefits of the new asset are different, cash benefits of asset being disposed of is different. That is why you like doing accounting for the exchange, right? When your cash benefit is not changing, whether you use the old asset or not, it doesn't affect the entity's cash inflows. Then students, why are you exchanging it? Why are you tampering with the books? Change the asset's name but keep the value as same only. This is the carrying amount model. This is case study. This case study could come in paper. This should be in your knowledge. That is why we are doing situation 2. I know that more than half the students will make mistake in this. Even though it is very easy, still mistake will be there. There's nothing to do. Neither check fair value nor any cash is involved. When cash benefits are same, why would cash be involved in between? Cash is never involved. No gain or loss. Values will not change. Name of the asset will change. Write it down in your notes. In the given situation, we will recognize the newly taken up investment property at carrying amount of given up assets. It means that we will not consider any fair value and there will be no gain or loss. On the exchange of assets, fair value of taken up investment property. 15 lakhs is given to us. Fair value of assets given up is given as 25 lakhs over here. WDV of given up assets, WDV of given up assets we will take 18 lakh rupees. It is found that if there is no commercial substance in above exchange, pass general entry you have to enter. We will write in the journal entry. These values will not be used. Only 18 lakhs will be used and change carrying amount. Is that clear, students? We will pass entry in this. Investment property debit 18 lakhs to given up assets. Being exchange of assets made in lack of commercial substance, this concept is very simple. Also write an exceptional note. If question remains silent on commercial substance, then if any student is lagging behind in taking notes, you can pause the video and you can finish your notes. You are owners of this class. So you all are very important. You can pause and resume, and pause and resume again as you like. It will be assumed that Commercial substance. Exists in transaction. Commercial substance does exist. Okay, so students, I have explained this concept of exchange of assets to you very easily and in detail. I had held it for this reason in the previous video because I wanted to give this time. Now is it alright? Are you satisfied? Purchase by cash was done. Self-construction was also done. Deferred credit also completed. The exchange also completed. But now we have one case remaining. Look. Where did we start from? This is our case 4. We should move on to case 5. In case 5, I will also show you that. I have saved this entire file. So here, this was our concept number 5 of initial recognition. We had created a chart. We have discussed all these cases. And now we are standing in this 5th case in the assumed owner's books. So when a property is taken on a finance lease, okay, write on a new page, case 5. So if investment property is acquired on the finance lease, we are talking about the assumed owner. We are talking about the lessee, students. This concept, this will also be discussed in Ind AS 116. Okay students, Ind AS 116 is on lease, and even in that we have discussed it all, that how to pass the first entry in the lessor's books and how to pass the first entry in lessee's books. But when we're talking about investment property, and we have discussed all the methods of purchasing, so why leave out this one? So what I will be saying here is only in reference to 116. But I will say, I told you that in the finance lease, in this finance lease case, lessee is our owner. We consider it to be the assumed owner. And students, if I take a property on a finance lease, if I pay lease rental on it, those are not considered as lease rental. Those are considered as installments. This is a case of hire purchase. And I also mentioned that the logic behind all this, like why it considered hire purchase, its factors. All this will be in 116. Here, believe me, if the teacher is saying something, it will be true. In a finance lease, the lessee that we have is assumed to be an owner. The payments that he is making will be assumed as installments, and we will also assume that he is charging interest to pay for his loan. So when you assumed him as owner, now when he will bring asset on rent or when he will bring on finance lease, so then in the first entry you will have to recognize the asset. You will have to recognize it as an owner, okay? When you are considering it as owner, then the owner passes the entry to purchase the asset. When you purchased it with cash, then the entry was passed as investment property account debit to cash. We will pass the entry in this. IP account debit to lessor. We call the lessor as lease liability. What do we say? This is called a lease liability. This is a type of loan that you have booked, that you have purchased the asset on loan, if bought in cash. So investment property to cash, if bought on deferred credit, then creditors would have done. investment property. We purchased it on lease, so we booked the lessor. And this lessor is nothing, it's a lease liability. You will continue to pay while charging interest. But students, the main issue is that on what value will we pass this entry? So this entry will be passed on the present value of lease liability. The present value of lease liability, let me explain you all simply. The money that lessee has to pay during the lease period. You should calculate the present value of all those payments. Suppose if the lease period is 8 years, the installments that we have to pay in 8 years, which are lease rentals, write all those lease rental, discount them at the market rate, calculate present value. So that present value is going to be the value of your property. As we used to do in deferred credit, the same concept applies. All the cash outflows that you have, the ones which you have planned in the lease agreement, calculate the present value of all those cash outflows and then you can record it. And what will happen in the future? We will pay interest and make installment payments. We will due interest and then payment. This is the deferred credit accounting. The accounting is the same, but the agreement is different because it is a lease agreement. So if I bring in an asset on the finance lease, then I will first check how much money I have to pay. Then I will note its present value and then the entry will be passed. That's it. Okay? And I had already written this. Rentals accounting will be handled by 116. So charging interest and payment, charging interest and payment, charging interest and payment, charging interest and payment, charging interest and payment 116 will handle. Here we only have the initial recognition. If any lessee has taken a property on finance lease, so then initial recognition will be made. So the initial recognition will be made at initial recognition will be made at present value of present value of the lease liability. Other name for lease liability. Lease rentals, meaning cash outflows. So if I have to pass the journal entry, I will pass the entry. Investment property debit to lesser account present value of all future cash outflows. all future cash outflows being initial recognition made, so being initial recognition made, this isn't anything special. We need to convert the cash outflow into present value and pass the entry. And then, charging interest and pay. Charging interest and pay is same as it was in deferred credit, but learn this in 116. Create a table. We will show all the payments in the table, including the interest. What balance will come out, 116 will handle them. Our work is finished now. Can I show a question? It's in study material. Don't know why it's given. 6th, 7th, 8th, 9th, 10th. Here it is. Question 11. This is supposed to be for self-reading, but I'll do this. Okay. X Limited, as the lessee, has taken a building under a finance lease from the owner. A building is taken on finance lease by lessee. Lessee is the owner. And we have been given the present value of the minimum lease payments, 40,000. The present value of your lease payments has been calculated and provided to you. If the present value is given to you, then our work is easy. Present value of lease payments. Don't focus on this word minimum, okay? Why is this minimum? We will see in 116. Just focus on lease payments. Present value of the lease payment is 40,000. At what value will X Limited recognize the investment? The present value is given at 40,000. So the X Limited shall initially recognize the property at 40,000. The corresponding liability of 40,000 will be recognized as follows. Investment property debit to finance lease obligation. Here you can also write lesser or lesser account. You can write it. Lease liability is written. For the finance lease obligation, you can also write lesser. So we have covered the 5 concepts of purchasing. Cash, deferred credit, self-construction, exchange or finance lease. I have explained these. Our 5 concepts are now completed. Concept number 1, meaning of IP. Concept number 2 is out of scope. Concept number 3, relation of 40 with 116. Concept number 4, various issues. Concept number 5, initial recognition. I am taking you towards a very new concept. Concept 6. Concept number 6. Subsequent recognition. Concept number 6. Subsequent recognition. You should mark this as important. You might be thinking, what does subsequent recognition mean? Now I told you in the concept number 5. Initial recognition. So students, when we spend money on a property for the very first time, then what entry do we pass? It's purchase of property. First time we will spend money. So the purchase of property. You have now purchased the property. You are spending more money on it. When you will spend money on the property that you have bought, students, then we call it a subsequent recognition. So here the Ind AS 14 clearly states that if you will spend the money again on the purchased property, so divide them in 2 categories. It would be in the form of repairs, or else it would be in the form of a replacement. When you spend the money again on the property that you have already bought, so two cases are formed in subsequent recognition. Repairs and replacements. What is the meaning of repairs? There is a simple meaning of repair. Day-to-day servicing. So students, now day-to-day servicing basically means that when you don't make any additions to the property, when its value is not incremented, okay? You are just spending the money to maintain the normal performance of that property. So students, if I spend money on an investment property and its performance is not changing and value is not increasing, so then I'm just doing this to maintain its normal performance. No changes in performance, no changes in value. So these are repairs. So this is the maintenance, this is your day-to-day servicing. Put this expense in profit and loss. It's not capital expenditure, it's revenue expenditure. Put it in profit and loss. Let me explain you with an example. Elevator maintenance. The property you bought has an elevator installed in it. That elevator has an AMC, which is annual maintenance contract. So now the elevator's maintenance, that is your day-to-day servicing cost. From giving the AMC of the elevator, for giving the annual maintenance contract, there won't be any increase in value of property. The elevator keeps working. That's the reason. Paying property tax. You are paying property tax every year. Paying the property tax doesn't increase the value of your property. You must have one maid or one servant which you have kept who cleans your property for sweeping and mopping. This is all day-to-day servicing. If a faucet breaks, you get it fixed. If the paint on a wall has peeled, you get it repainted. If a tile on the floor got broke, so you had it repaired. This is day-to-day servicing. This is repairs. This has absolutely nothing to do with your value addition of the property. Okay? These types of expenses do not contribute to the value increment of the property. Okay, everyone? It doesn't contribute. Put them in the profit and loss. But on the other hand, there is a replacement. We often call replacements renovations as well. Now you have bought a building and that building had an elevator which was old, or there was no elevator. So you got a new elevator installed, new elevator, or remove old elevator and install a new instead. This is a replacement. This is a renovation. This is an improvement. When a new elevator is installed in a building, its value increases. Let's say there is a building with 4 floors, ground, first, second, third, but there is no elevator in it. Tell me who will buy the third floor? Who would break their legs to go to the third floor? If we install an elevator, the value of the third floor, second floor and first floor will increase. Value of the building will increase. Do you understand? Renovation, improvements, additions, replacements, all of these are the same. All of them indicate the capital expenditure. You are talking about the replacement, you are talking about addition, you are talking about improvement, you are talking about renovations. This is all the same. You are talking about capital expenditure here. Now I will give another example to you. You have replaced all the floor tiles in the entire building. And you have also put heavy interiors on the walls of the building. You got the ceiling done with POP. Your building is all new and shiny. The price of a new building will definitely be higher. The amount of money you spent on the building, you have also replaced the fittings in the bathrooms. Fixing the tap, or a knob got broke, so you changed that too. And you changed all of the fittings, the amount that is spent on renovations. All of that money is capital expenditure. And now the India has 40 states that you should capitalize all of this. And then just add this to the cost of the property. The amount of money that will be spent on replacement and renovation, it will be added to the value of the property. Okay? Put it in profit and loss. So you have to capitalize this. Okay? The students are thinking. You had already told this earlier. When you were explaining purchase by cash, it was already explained there. Why are you explaining it again? It was in general sense there, and here it is going to be in accounting form. So first I need to explain to you the accounting for the replacement when we do renovations. But then how do we do the accounting for those renovations? What are the challenges that you will face there? I will discuss that. I don't need to tell you about repairs. You've been studying them since the 11th grade. Repair and maintenance account debit to bank. P&L account debit to repair and maintenance. What can I explain? I need to explain you the challenges of replacement. You are wondering what is special about replacements. If you need to capitalize the property, then you will pass the entry investment property account debit to bank. You can capitalize the expenditure. No students, it is not that easy. I have to discuss two cases in this. First, let's write all of this. Then I will teach you the accounting. Under subsequent recognition, an entity may incur expenses on existing investment property if any expenses incurred. After if any expenses incurred on investment properties after initial recognition, then it will be classified under the two different headings. As follows. We will divide the expense in two headings. First is students. When we talk about subsequent expenditure, we have two forms of this. First, second, now either this will be in the form of repairs repairs and maintenance, or this will be replacements. And in the form of improvement. Case 1. Repairs and maintenance. If any expense is incurred on the repairs and maintenance, then it will be written off in the profit and loss account as an operating expense. It means that such an expense cannot be capitalized. Cost of the property, because this expense does not contribute in value appreciation, but this to maintain normal performance of the property. What can be included in the expenses? So this may include lift maintenance. This can include property taxes. This can include repairs of walls and floors, day-to-day service cost, incurred on servants or maids. Okay. Have you hired any employees? Yes. And that employee keeps your property neat and clean. All these expenses of yours are of day-to-day maintenance. You have kept a guard that no theft takes place by breaking into the property. I have a farmhouse in Punjab because all my relatives live in Punjab. I thought that how Jatin would connect with his people. As he lives in Delhi and will go out of Delhi to study in a foreign country, so he should not forget his relatives. So I have built a farmhouse. I created a property which he will have to visit. Okay. When he will visit, then he will stay in touch with all the relatives. I am in Delhi, but my property is in Punjab. Now if anyone enters the property, so there I have employed one watchman permanently, and also a gardener or his family is there to take care of the surrounding area and to give water regularly to trees and plants. So the value of my property is not increasing because of this. This is just daily maintenance. I have kept people to ensure that the property is not damaged. You need to hire employees to do the work. We cannot survive without them. I am grateful to them that they are providing their services to me. Case number 2. Case number 2. Replacements. And improvement. We will capitalize this. If any capital expenditure is incurred on the replacement and the improvement, so then it will be capitalized to the cost of existing asset instead of transferring it to the profit and loss account, because such an expense contributes to appreciation in value of the property, and to the expense on the new lift and replacement of The old lift. Interiors. Replacement of floors. The major difference between maintenance and replacement is this. Now the students are saying, sir, we already know this much. Please continue further. So this leads us to the discussion of accounting. Okay. So if you have to do accounting, then do. Accounting for subsequent recognition. So if you have to do accounting for the purpose of subsequent recognition, so case 1. Please tell me what was case 1 about. The first case was of repairs. So what entry will we pass here? First entry, the repairs account debit to bank. We will write being in this. Expenses incurred on repairs. And we will pass the second entry. Profit and loss account debit. Being so remember one thing, I have used the word repairs here. And what would you do? You will be using the name of that particular expense. If it was lift maintenance, so lift will be maintained. If it is property tax, then it will be property tax. These all fall under this. You have written an example above. Day-to-day servicing, repair and maintenance are all the same. They all go to P&L. Now we'll move to second case. My page is over right below this. Case 2. Replacements and improvements. The replacements and the improvements. I have ticked on it. It's very important. I have brought you till here so that you can understand this concept. If you have to do accounting in this, if you want to do accounting of the replacements and improvements, so there are two cases of this. For this, two different cases are made. If replacement is for different components of IP, if replacement is done, if replacement is for an integral component of IP, so see here, it is an integral component and one is different component. So let me highlight this. This concept should be in your knowledge. I claim that more than half of the CA final students don't even know this concept exists, and the replacement is learned in a very simple way. So we need to move forward, and there are two cases of this. Later we will do questions on this. It is there in study mat. I am talking about, this is our unit 1 and this is our unit 2. I will give them the names of units. It will become easier to talk about it. So I am writing here an explanation on unit 1. Explanation on unit 1. You might be thinking, what is this? Wait, I'll tell you. You have not studied in AS 16. Of PPE, I know about it. Because I will record after Ind AS 40. But I know, okay, so I know very well that you have studied the accounting standard 10 in CA Inter. But we have not studied this at all. You said in beginning that I wouldn't refer to AS. I won't give reference of Inter. I'll assume that you are learning from scratch. I'm not saying anything. But listen to this quick reference. So in your CA Inter studies, you must have studied a concept in accounting standard 10, component-based depreciation. What happens in component-based depreciation? I'll repeat it from the beginning. Let's start. So in Inter, I always used to give an example of an aircraft. Indigo company has thousands of aircrafts. So inside this aircraft, the most important part of this is the engine. The second part of this is the interior. And the third part of this is its inspection. In any of the aircraft, these are the three important parts. Engine, the life of this is usually considered to be around 15 years. And the interior, so in the interior the seats are included and the fabric of the seats also. The TVs that are mounted inside the aircraft and also the carpets. That whole system, the AC is also included in interiors. The lifespan of this considered to be of 5 years. So after every 5 years, right? In 5 years you might have to change the interior of this. The engine will last for 15 years and the interior for 5 years. Then there is inspection. It might be any crafts. But you can't fly without inspection because the passengers' lives are at the risk. So it is important that you have to get an inspection done every 3 years. After 3 years it is inspected and they see that the craft is properly working and if it is airworthy or not. After inspection we receive a license for it. So whenever we talk about the cost of an aircraft, so there are the three breakups of its cost. Let's say I have bought an aircraft for rupees 1500 crore. I have bought an aircraft, a machine for rupees 1500 crore. So I have to divide this into three parts. And the place from where I will buy will give me the breakups. That I am charging this much amount for the engine. Let's say 800 crore. And for the interior, we are charging around 400 crores from you. And the remaining 300 crore we have charged you for the inspection. And you will have to get the inspection done in every 3 years. Okay. So you will have to spend 300 crores in every 3 years. And you will also have to spend 400 crores after every 5 years. And in 15 years, your engine will be finished. So we'll move aircraft to the side. You have not understood what I'm saying? So basically what I want to say is that you must have studied in the accounting standard 10 at the inter level. And you will also study in Ind AS 16, component based accounting. Component means that you have purchased an aircraft, but the aircraft will further divide into different components. It will divide into three parts because there are three components inside, each with a different lifespan. If lives are different, then depreciation will also be different for each one. So if I need to calculate the depreciation of aircraft, then it will not be calculated on the life of the engine. The depreciation of aircraft will be calculated based on the life of its components. I will take one depreciation from here. I will calculate one depreciation by dividing by 15 and another depreciation by dividing by 5. I'll calculate the depreciation by dividing by 3. Then I'll add these three values and tell you that this is the depreciation of the aircraft. And understand one more thing. Your engine will be running. However, you will have to face the replacement of your interior. Okay. Your interior will be running, but then you will have to face the replacement of your inspection. Is this clear? Its lifespan is of 15, it has 5 and it has 3, so this one will be replaced first. The old inspection will remove and new inspection will come over. The old interior will be removed from here and new interior will be installed. So the concept of the replacement is the component-based depreciation. And it can prevail in the component-based accounting. When an asset is made up of different components and the lifespan of each component is different, so the one with the shortest lifespan will be replaced first. And if someone's life is little longer than that, then it will be replaced. So if you are making the replacement in this environment, if your replacement is happening within this environment, then you will have to learn the method of how to do accounting. So I will make you do this as case 1. Unit 1. If the replacement is for different components. So let's assume that you have one investment property. You have a building. So there is one such component inside this building whose life is different from the life of a building. Let's say the building's lifespan is 50 years and this component's lifespan is 10 years. So this component needs to be replaced after 10 years. So then we will do accounting for this separately and for this separately. This is your component. And its life is also different. So here I want to explain you this in unit 1, that when your accounting is happening in a component based environment and you are not changing the entire asset, you are changing one component only. And the accounting is also kept separately because its life is different. So how will we do the accounting? So for this, here I have 2 steps for you. So whenever you will do the replacement of a different component, then you will have 2 steps for the accounting. Now listen to me carefully because I am teaching accounting and stories will not help. Accounting will be useful. So this is the first step. And that is the recognition of old component, the component that you are replacing, so first remove the old one and the new one will come later. First, we will remove the old one. When we remove the old component, then that process is called as the recognition of the old component. If you are changing something inside your property, you will first remove the old one, then new one will come. So when the old one is removed, the carrying amount will remain with you. So your books will have a certain value assigned to them, which is called as the carrying amount. So you will have to make an entry, bank account debit, P&L account debit to asset. Now you are thinking that how to pass this entry? When you will remove any of the old asset. So then you can get some kind of the scrap. If you've received scrap, your bank account will be debited. If you remove the old asset, you may receive scrap. The scrap value will be debited to your bank account, if any. This is WDV. This is your carrying amount. You can find the carrying amount from the books. And the difference of these two will go in P&L. So this is your old asset that we have removed from the site. If the building has a different life and the component that you are replacing has a different life, since they have different lifespans, you should apply component-based depreciation. Now let's say there is a building. The lifespan of the building is of 50 years. And inside that there is an elevator. The life of that is 15 years. So then you will have to keep the elevator's account separate from the rest of the building's accounts. The elevator is a different component of the building because the elevator will depreciate first and then the building will depreciate. So the lift will be replaced 3 times in the lifetime of building. The old one will be removed and a new one will be brought in. So first the old one will be removed. If we remove the old one, we need to do 2 things. One is to remove value from the books and other is to record the scrap. Let's say the value of your books is 10 lakhs. You received 1 lakh, so 9 lakhs were lost. When you write off in PL, then you have removed the old asset from your books. The second step is to record the new asset. When we record the new asset, what entry will we make? New asset account debit to the bank. The old component has gone and new has come in. So according to its own life, depreciation will start to come out. When you bring in a new asset, it has its own life. New life, so new depreciation will start coming. The old component has been removed, so its depreciation has stopped. The new component has been recorded and its depreciation has started. It's as simple as that. I just wanted to tell you this point. Okay, students. So we will write in this. The first step the recognition of old components. So will we do a question on this? Yes, in 2 minutes. Without questions, I don't move forward. The recognition of the old component. We will pass an entry bank account debit. What is this? This is the scrap value. Profit and loss debit. Loss on the recognition. We call it a loss on sale. 2. We should write 2. This is WDV. So here, there can be a gain as well. Now the scrap money isn't enough to exceed your book value. So the scrap is scrap. Okay? No problem. 2 PL. Gain on the recognition. So here the balancing figure will come. So the balancing figure will come. Meaning WDV minus scrap is equal to loss or profit. So we are doing this. Write in second step. Recognition of new assets and new components. How will the recognition of the new component come about? We will pass the entry. New asset account debit to bank. Note. Depreciation on new component will be computed according to its life. I gave you the example of a lift. So the lift will depreciate over 15 years. 15, 14, 13, 12, 1. No. 15, 14, 13, 12, 11, 10. 9, 8, 7, 6, 5, 4, 3, 2, 1. Then a new elevator will come, then 15, 14, and then it will start again. So I am accounting in the environment of different component where the old has been replaced with the new. So we will see one practical question. It will give you some comfort. In my opinion, you all should study this. Question number 19. You need to focus on this question. It's very important. That's a very good question. If any student's noting is left behind. So you can pause me, right? Okay, you know this? Does any child need time to read the question? Then you can pause me, okay. And I will keep talking. I will start reading the question. X Limited acquired a land for 15 crore. Here it's not and it's A. X Limited acquired a land. X company has bought a piece of land for 15 crore and they have constructed a building on it of 40 crore. So the land is worth of 15 crore and the building is worth of 40 crores. Depreciation is not applied to land, but depreciation is charged on the building. So both land and building are separate. So the building is of 40 crores and land is of 15 crores. So total is 55 crores. We'll look at the total later. First focus on the building. It's of 40 crore to be used for letting out for the commercial and the residential purposes. Under the varied lease terms, what is written there? Letting out. As we talk about the letting out, he's talking about the rent of an investment property. So this building is an investment property and it is of 40 crores. So we need to apply depreciation on this. Okay, now I will move on. Interior walls in the common space were decorated at a cost of 120 lakhs. Keep one thing in mind. We have not done the interior work. It was decorated. Building was purchased. One is buying the building and I had the interior done later. Interior came along with this building. I hope you understood. If building is worth 40 crores, then my building is worth 38 crore and 80 lakhs. While my interior is worth 1.2 crore rupees. When I buy any building, I don't pay separately for interior of the building. It comes along with building. The price of the building includes all inclusive in it. So it is a 40 crore building. We don't have to worry about the price of interior in it. And if we talk about this interior, it can be a component if its life is different. So here 15 crore worth of land is purchased. Building costs 40 crores and its interior costs 1 crore 20 lakhs. It was like this since before. The land was acquired and the building was constructed. The walls were decorated. All this is in the past. We are discussing it now. I didn't do anything. That's all old news. Let's read more. The useful life of the building is estimated to be 50 years. Life is 50 years. Building's life is 50 years. That of the interior decoration is 15 years. This is a 15 years life, while this has 50 years lifespan. When they both have different lives, so you will have to follow component-based accounting. Otherwise, you can't calculate depreciation. Moving ahead with the question. Next question is, after 10 years, what 10 years means? It has 40 years left. How many years? So there are 40 years left, while this has its 5 years remaining. After 10 years, the entity changed. The interior decoration at a cost of 1.5 crore. The old interior was removed and a new interior was constructed for around 1.5 crores. There was a replacement. We will remove the old and bring in new. Component-based accounting will be followed here because both lives are different. And estimated a new useful life of 15 years. New decoration has a life of 15 years. And find out the depreciation charge during 1 to 11 years. Furthermore, also show the accounting entries for the replacement of the interior wall. Here you have to do 11 years of accounting. From 1 to 11, what will happen in 1 to 11? Accounting for 10 years and 1 year will be different and separate, while the accounting for 10 years will be with the old interior, whereas the accounting for the 11th year will be with the new interior. I will cover all the questions for you. I want to say first, we should write solution here. This is question number 19. Tell me, first what should I do? First of all, step 1 will be applied. On what? The derecognition of existing component. How will derecognition happen? We have to calculate its carrying amount. You have been using the old interior for 10 years. You have been using the building for 10 years. So after charging depreciation for 10 years, you need to find what is the carrying amount today at the time of the replacement, and at that time what is the carrying amount of the building and the interior of the building, because until you know the carrying amount, how will you derecognize it? First, you have to write the calculation of carrying amount, and then building and interior, building and interior. At the end of 10th year. And what happens at the end of 10th year? First column will be building. I created next column as interior. I have made the next column total. Building, interior, total. I have written original cost. $38.8, 1.2. Total is 40 crore. Payment for interior is not paid separately. The building was purchased for 40 crore and it was all inclusive. So the interior that is old, it's all inclusive in the price. I will deduct depreciation. Depreciation for 10 years. It's a simple matter. 38.8. This is the cost of building. Its life is 50 years. Tell me the depreciation for 10 years. The cost here is 1.2. Its life was 10 years. 10 years. Please let me check. It's 15 years. Building's life is 50 while interior's life is 15 years. Its life is 15 years. If 10 years have passed, do write off. Tell me. 38.8 divided by 50 then multiplied by 10. And now I have also charged the depreciation for 7.76. Okay? Let's check this in calculator. So this is the depreciation I have charged for 10 years. And total depreciation? I have charged it around 8.56. We will call it a carrying amount. At the end of the 10th year, $38.8 minus 7.76, so this becomes 31.04. This will be 0.40. 31.44. Okay. What is next? The accounting for replacement. Tell me what has been replaced. So the interiors that you have are replaced here. The interior are part of the building. I can't afford to buy a building worth 40 crore. I'm just a teacher. Right? I just eat 2 meals a day, and how can I manage to buy 40 crore building? And now here just pass the first entry. Profit loss account debit. 0.4. To interiors. 0.4. Has there been any talk about scrap? Old interior was removed and some scrap was recovered. Is that right? Is there any scrap that we will get? No. No scrap was found. If scrap is not available, everything will be write off in P&L. Being existing. The loss is reduced due to scrap, but we did not receive it. The existing interior is derecognized. The existing interior is derecognized. Let's see second entry. New interiors account debit. 1.5 crore. To bank. 1.5 crore being. Replacements recognized. Old is gone, new has arrived. First, what did we do? We depreciated it for 10 years. We calculated carrying amount in 10th year. The walls were removed and replaced. Calculate new depreciation. Calculation of depreciation for the 11th year. We are discussing depreciation in 11th year. How to do it? One column is of building. Another is the interior. Third is total. What should we do first? First, we will write opening balance. The closing balance of the 10th year and the opening balance of the 11th year. You should check it. 31.04, 0.40, 31.44, 31.40. 0.4, 31.44, D. Recognition. Recognition. We removed 0.4. We recognized 1.5. Balance is after replacement. There are no changes in this. This will be 1.5 and total will be 32.9. Calculate depreciation. Depreciation for current year. The current year is 11th year. 31.40 divided by 40 years. 1.5 divided by 15 years. How this 40 years remaining? 10 years have passed. 10 out of 50 will be 40. The basic idea is the original cost and the original life. Original cost, original life, remaining cost and life. So this 31.4 is not the original cost. This is after 10 years. If this is after 10 years, life is also after 10 years. 31.4, 0.7, 85. It's not 31.4, it is 31.04. I am sorry guys, I made a mistake here, it's 31.04. This is 04. Okay? Fine? Right? It's 31.04. And here will be 32.54. This is actually, I mistakenly wrote 31.4 instead of 31.04. I have corrected this. Here also, it will be 31.04. This is depreciation. It will be 0.15 here. Total 0.926. Carrying amount after 10 years? No, after 11 years. We have completed accounting for 11th year. Okay? This will be 30. 0.264. Let me check it once again. It's fine. This is 13.5. I think there's a mistake somewhere again. There might have been a slight mistake. It will be 0.1. I know you have already corrected this. Right? Let's correct all the mistakes. 1.5 divided by 15 will be 0.1. 1.4. 30.264 plus 1.4. 31664. Okay. It's okay if the mistake is found beforehand. Otherwise, the final answer will be wrong. This is a component-based replacement. First, remove old asset and bring new one. Then calculate depreciation as per its new life. The new life for this replacement column is 15 years. So the old part of the building will continue its life. New one will continue based on its new life. This will be the presentation here. And I haven't given you all the knowledge yet. One of my cases is still pending in this. And that's Unit 2. But today's lecture is over. That's all I wanted to tell you. I extended the time of lecture today. Rest in next class. I will pick up the lecture from where I am leaving it. Thank you. Take care. Please revise all this. See you in the next class. Bye. Do the revision.